When you're starting out and growing a business, you are basically taking on clients that have a pulse. However, you're going to very quickly acknowledge that not every client is going to be a good, profitable client for you.
Today, I am excited to be here with Rich Munroe. He's the managing member at Diamond Edge Properties. He's also the host at the BNB Investing Podcast. He's a real estate professional with more than 29 years of experience, having acquired hundreds of properties and portfolios across several asset classes. Someone that's extremely involved not only on the hospitality vacation rental side of things, but also on the regulatory front, having founded and formed a nonprofit, the Atlanta Metro Short-Term Rental Alliance. Downsizing can sometimes be beneficial for operators and property managers. I'm curious to know your thoughts on downsizing as a strategy. Why did you go through that, and what did you learn in that process?
We've fired clients. If you're spending 90% of your time with 10% of your clients, that becomes very counterproductive.
One bad review from one bad guest can kill your overall ratings. How are you trying to maintain those quality standards despite the pressure from the OTAs to maintain that quality?
I actually like it when things go wrong.
Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality, and where we bring here leaders, operators, founders, investors in the vacation rental and real estate space so they can tell us about their stories, the lessons that they have learned along the way, as well as perhaps some of the mistakes that they have made along the way, so we don't have to make those same mistakes ourselves. Today, I am excited to be here with Rich Munroe. He's the managing member at Diamond Edge Properties. He's also the host at the BNB Investing Podcast. He's, a real estate professional with more than 29 years of experience, having acquired hundreds of properties and portfolios across several asset classes. Someone that's extremely involved not only on the hospitality vacation rental side of things, but also on the regulatory front, having founded and formed a nonprofit, which is basically the Atlanta Association for, the Atlanta Metro Short-Term Rental Alliance. So basically, super, super excited to have Rich with us today. So before we get started, Rich, where are you taking the call from? And thanks for taking the time to join.
Yeah, absolutely, Sebastian. Thanks so much for having me today. I'm really excited to jump in. I'm actually in my home base up in Lawrenceville, Georgia. So it's about 30 minutes or so north of Atlanta.
Amazing, Rich. So listen, before we get into the timeline of your career and your journey, let me start with this question. If you had to start your let's say your real estate investing career all over again, and you could change one thing only, whether that's a mistake you would like to avoid or something you would like to do differently, what, if anything, would you do if you could start all over again with all the knowledge that you have today?
Yeah, so that's a great question, and hindsight's always 2020. But I think from all of the different ebbs and flows in real estate, I think one thing that a lot of real estate investors have in common is, financial stress and properties that don't sell on time, and you're kind of robbing Peter to pay Paul. And so there are, I've learned over the years, there are ways to structure your financing and work with private money lenders where you can actually earmark your private money loan to be specific to carrying cost and the funds that are needed to front the contractors to get stuff started, even though you have your hard money loan covering a lot of that. And so there's ways to strategically, essentially be able to tee something up as a project, even some of the larger deals where you're basically 100% financed, and alleviates a lot of the stress involved. And no matter what you do with rehabs, there's always going to be some surprise and some change in the budget. And so to the extent you can have any kind of financial relief, I think is important. And so looking back on it, there are many rehabs where I didn't have that in place. That that's probably one change I would make that would have made things a lot more smoother than some of the rehabs that we had.
Would you mind breaking that down for us in terms of what are the different layers of debt that you are referring to here, and how does that give you additional leverage, but also additional security to go on and maybe take on larger deals?
Yeah. So, a lot of investors, definitely, uh, and just I think in general, people don't really like taking on debt, but debt is really what kind of helps you excel your business and get you there quicker, and allow you to do more deals. And so, obviously, when you look at a distressed property, you're buying it as an investor. You typically can take out a hard money loan. There are a lot of hard money lenders, even in this environment, that are lending to experienced rehabbers, where in a lot of cases they can get close to 100% financing on not only the purchase but also the funding of the rehab. It's never going to be completely 100%, even though they'll fund the purchase and then they'll also fund the rehab. You still have to float the carrying cost of getting the rehab started, and then as you reach certain final stages of each section, you get reimbursed essentially. So what I've done is been able to align myself with other investors that are looking to invest their money passively. They don't really want to do the day-to-day operation of rehabbing or managing properties, but they do want to put their money to work. And so typically for anywhere from an 8 to 12% interest rate annualized, they'll contribute to that project, whether it's helping with the carrying cost and some of the floating that needs to happen, your interest payments along the way, as well as furnishing in the short-term rental world, furnishing and staging and setting up your property. And so you can align yourself with a partner that basically is earmarked for that portion of the project, and you're essentially able to pay them either at the time that you refinance the property, their principal plus interest, or at the time that you sell the property.
Hmm. And a couple of questions here, and I'm just trying to dig deeper into this, because if it's the thing you would do differently, and it's important to make sure we all can grasp it. So first of all, there's traditional lending, which in this case we're not even talking about, because you're saying is a distressed asset. Therefore, we eliminate kind of the traditional lending option, and that's where you're left with the hard money lending, right? Which is what you say there's a lot of, right? But then what you're saying is that even if you have the hard money lender, you still have to upfront a lot of that capital, before they start, reimbursing some of it, and also, the carrying cost of it all. What you're saying is to add like a third layer of debt to cover, that upfront need for capital, and also, the carrying cost, and that can be kind of like any private individual. So it's like a third layer of debt, or second, if you're only looking at hard money lending.
Yeah, it's kind of a second layer because, like, for example, most hard money loans you have to put 10% down, right? So, if the project is a $400,000 project, you've got to have $40,000 to put towards the deal. Unless you've got a lot of experience, a lot of track record, like I mentioned before, they'll usually finance most of it. And so that's 40,000 for the down payment. You might take another 40,000 for carrying cost over 6 months that it might take you to fix the property up. And then you might do another 40,000 for once the property's fixed up to actually stage and set the property up so you can immediately start generating revenue with short-term rental, before you have to go through the process of doing the refinance. So that's 120,000 in that example. In most cases, private money lenders are going to have some form of security, and obviously the hard money lender is in first position. And so if you're able to strategically uh, get that private money lender comfortable with either a first lien position on another property that you own, or in second lien position on that property if there's enough coverage as far as what you're buying it into versus what the after repair value is and appraised value. So in either case, sometimes they can do second position, or sometimes you can use other properties to put them in first position.
Interesting. um two things that come to mind on this note. One is, how much leverage is too much leverage, right? Because with more leverage comes the opportunity to take on more projects, to refinance and go buy the next, and you know better loan to values, means better returns, because the less money you put in to the deal, you know if you put zero money into a deal, you can have infinite returns. But like, then you have to be careful not to over leverage yourself. So how do you think through how much leverage is too much leverage in your deals?
Yeah, so there's a lot of basic guidelines that a lot of the lenders follow, as well as just in general investing 101. And so typically, as long as you're in that 65 to 70% of the appraised value, so your purchase cost plus your rehab cost not being more than 70% of your after repaired value, you got a 30% buffer there theoretically once you're done with the repairs, that you're already coming into that deal with equity. Now, each real estate deal, you're basically partnering with the lenders, so the lenders will get their 10, 15% after your points and everything. And you're also partnering with contractors, so if you have enough profit in that deal to go around between yourself and those two entities, that's usually where you want to make sure that you're careful not to be over leveraged. And if the deals start to be too tight or they're smaller deals, that's where you can kind of get into trouble with that. But some of the deals we've done recently are kind of luxury and higher end. And so when you're looking at, like a $700,000 or $800,000 purchase price, a $200,000 rehab, and then a 1.4, 1.5 million after repair value, there's enough buffer there in terms of not being over leveraged.
Right. So in other words, like, if you look at it as how much you're borrowing versus the current value of the property, it might seem like you're over leveraged. But if you look at it as based on, compared to the after repair value, then that's where, you want to stay at the, 70% or so of loan to value.
Right, because depending on your exit strategy, right, if you're a buy and hold investor and you're basically doing the rehab for the purposes of keeping the property, once you've repaired it and you get it appraised again, you essentially can get it refinanced at a much higher rate, usually 75 to 85% of appraised value. And so you can at that time pay off all your debt partners and potentially pull out some cash as well, and then refinance it into a longer term loan as well.
Absolutely. Now, this makes it so that the calculation that you make up front, or the assumption that you make up front of what that after repair value is going to be, like that becomes a very important assumption, right? So
Most definitely.
what have you learned throughout the years in terms of making that assumption as accurate as possible, and where do you see investors make mistakes when it comes to maybe being too optimistic about that after repair value?
Yeah, it's definitely better to err on the side of being conservative and end up being higher than what you originally planned. Unfortunately, appraisals are very subjective, and depending on the type of property, you could definitely have a pretty big swing, either 10 or 15% one way or the other, higher or lower. And so even simple things like making sure that you understand if the basement is including square footage, or all the windows underneath, below ground grade level. That little thing there can kind of blow a monkey wrench in what you think you can sell the property at. And it's very similar in the short-term rental world when you're looking at comps and trying to determine your competitive market before you go live with a property. You usually want to look at very closely at the listing pictures. How do they compare to your prospect? If they have any different amenities from you. So it's a very similar process, right, in this appraisal, to make sure that the ones you're hanging your hat on are in fact, as close as possible to the prospect that you're about to rehab, and the finishes and everything that you plan on doing with that property. And so
Mm-hmm.
um, the things that you have obviously no control over is any major changes in the resale market, and any ebbs and flows with supply and demand and interest rates going up and down. And so that's why you typically want to be very conservative when you come up with that appraised value estimate.
Interesting. uh, I want to try to understand your investment thesis, and how it has evolved throughout the many years of experience of yours. But specifically, there's one I don't want to call it a debate, but there I always like to ask people, if they're buying for cash flow or if they're buying for, let's say, internal rates of return, in terms of considering the appreciation as well significantly, specifically the forced appreciation that they think they can add in terms of value to the deal. uh, and I always get like two opposites, in terms of the answers. Like, I get the people that come from the, let's say, multifamily world. They're big on leverage. They're big on, the buy, renovate, refinance, repeat, burr method. And they're big on, because it's, you know because the value of the asset is calculated on, you know the net operating income and cap rates. Like, they can predict in a more precise way what that, value will be after they have, let's say, increased rent or, decreased costs. So they'll be buying, for that forced appreciation component, even if it is at the sacrifice of cash flow, right? And cash returns. But then I have on the other extreme, and the reason I want to get your thoughts is because I know you have kind of a mix of, different asset classes. On the other extreme, there's the people that say, I'm just buying something that cash flows, especially when it's, STR, short-term rental investors. I don't care about the appreciation. That's speculation, as long as it cash flows. That's the only thing I'm buying. So now that we have those two extremes, where are you situated, and how has that evolved throughout the years of experience that you have built?
Yeah, no, so that's another great question because each of us have different goals and objectives and targets, whether it's building equity or building net cash flow. And what I've found to be true, and just like you've described, and this is one of the reasons why we're kind of pivoting and going more into the commercial space, is you have a lot more control of your destiny and valuation and value add, and appreciation. And the when we talked about doing a fix and flip, and you're kind of at the mercy of what the sales activity has been in the last 6 months, not which you have zero control over in terms of what the market will bear. They don't really care that you're doing 25,000 a month in short-term rental revenue. They're still going to pay you for that asset what the house that sold down the street or in the neighborhood next door. They're not going to pay you any more than that, right? And so the in my residential, real estate investments, most of them have been strategically around, what's that net cash flow, what's the paying attention is, of course, to the exit strategy and what your equity buildup is over time. But I think in the commercial world, and specifically, we're starting to look a lot more at, older distressed hotels that are kind of mom and pop owned, that we can do conversions into boutique hotels. It kind of fits nicely with the short-term rental hospitality operation, with kind of a plug and play, and kind of automating things with self check-in and things of that nature. And so, as well as in a 3 to 5 year window, I have a lot more control over making improvements, whether it be the operation or the asset itself, to increase that net operating income. And in that same 3 or 5 year window, I'm able to kind of get much more higher multiples on increasing value, right? So if I put 5 million into that deal and I'm able to make it into 10 million over 5 years, that same 5 million, if I bought five different luxury homes, it's doubtful that I would 2x it or 3x it, right? So I think when you talk about where can you get your biggest bang for your buck, the same reason I do short-term rentals instead of long-term rentals, you're doing typically 2 times the long-term rents, and in some cases 3 times. You've got that same asset, you're doing the same process, why not, or similar process, why not focus strategically on doing short-term rentals? And so it's a similar, for me, light bulb moment with commercial and the hotel space.
So in other words, you do think it's like in your investment thesis, so to speak, you do tilt more towards the, making sure that you can add value to the project, making sure that that you consider the forced appreciation potential of a deal. You do give a lot of weight to that when you're looking at a deal versus just the cash flow potential.
Yes, most definitely.
Hmm. And tell me, you because you said that was one of the light bulb moments you have. I'm curious to know, like, the timeline of your, let's say, career as it relates to investing in real estate, and what have been kind of the different asset classes that you've been exposed to during that timeline, but then also the light bulb moments that you've had, let's say, in each of those asset classes as you try to put the pieces of the puzzle together.
Yeah, no, absolutely. So, I was prior to real estate, I was in the consumer finance space, and we briefly touched on the 2008 recession on a previous conversation before we jumped on here. But uh, I owned a company that its business was dependent upon buying distressed debt from the bank, right? So we would buy credit card debt, auto debt, consumer loans, student loans, and then we'd buy it at a discount and then put it through a collections process. When the recession hit in 2008, a lot of industries obviously got hurt from that, but our industry in particular, basically the spigot got shut down. So we had our portfolio of debt. We were, outsourcing to attorneys and collecting on it. And it's funny how the numbers work. The objective there in that model is to generate 2 to 3 times your cost on buying a portfolio. When that '08 thing happened and they created the CFPB, a lot of the banks were no longer able to sell their debt in the secondary market and basically shut that industry down. And so that's what caused me to pivot into real estate with tax lien investing. It's a similar process to what I was already doing. You're investing in a debt instrument. You have an attorney that's going to put you through the servicing to get it a quiet title action placed so that you can get clean title to it. And so, I did some research on different states, and obviously each state's very different in terms of how they interact with and how the rules are applied. Georgia happens to be one of the more lucrative ones for investors, where you can buy a tax lien on a property, which is basically delinquent property taxes. And the county or the city will sell that to an investor and transfer the superior lien rights so they can keep the county government going, right, to continue generating revenue. And so you'd buy a tax lien, you'd have 12 months to be able to, the prior owner or anyone that has title on that property can redeem that plus 20% penalty. And then it's 10% for every year after that. So if no one redeems after 12 months, you can then file a quiet title action and take possession of the property. And so I tested that model out through my self-directed IRA, and probably did about 4 or 5 properties from start to finish, proved out the process, and then we obtained a credit facility of about 10 million and kind of ramped up the volume, not only here in Georgia but also in Maryland, Baltimore, PG County. They have similar. I think the redemption 6 months there and 18% penalty. So we were able to acquire about 350 properties through that process. And our cost basis was low enough where we sold most of those to other investors, let them do the rehab. But it also kind of showed us the worst case scenario of properties that have been vacant for a very long period of time, a lot of them through probate, or properties that were, slammed full with hoarders and just needed a lot of care to get them back on track. And so that's kind of what pivoted away from my prior career into real estate.
Just a little parenthesis there, and then we'll go into like how you got into other asset classes, including short-term rentals. So when you describe that model, which to me was new, right? Auction tax lien, right? um is that the same as, I know we discussed it before, but just for clarity for everyone too, like foreclosure? How is it different from the foreclosure? you also hear a lot of talk nowadays about subject to. How is it different from subject to as a strategy? Like, just if you could sort of put that strategy that you're referring to in context with these other two big words that we hear out there. How does it relate?
Yeah, absolutely. So obviously, foreclosures are similar in that they are both sold in an auction format, as are tax liens. And so you have to you do your due diligence, you attend the auction, and it's a bidding process for you to be able to be successful. Obviously, the foreclosure process is where the bank is the one or the lender is taking over from a delinquent mortgage, and they're auctioning the property at the county steps. Typically, those are going to get bid up to, in a lot of cases, very close to what the value of the property is, or just below it. Tax liens are, like I mentioned before, the county or the city government that the annual property taxes that are owed on a property, if the either and we've had mortgages, lenders and banks that have like stopped paying property taxes and have lost the rights to properties. And so it's not just the owner. So the property taxes go delinquent. Each county is very quick and diligent in a timely manner to make sure that they put those out for auction. And so it's a bidding process. The delinquent taxes might be 5,000. It could get bid up to 40 or 50,000, and then the property could be worth 150 or more after it's been repaired. And so the subject to is where you're basically able to acquire a property subject to the existing mortgage, and you're basically taking over the prior owner's mortgage payments, and you put in documents at closing that kind of protect you both. In the event that you stop paying, it kind of reverts back to the original owner. But with the interest rates being higher, that's been a popular way for investors to build their portfolio, because you're basically got a lot of mortgages that are out there that are 2, 3, 4% or 5% interest rates. And rather than getting a brand new mortgage, you can basically negotiate a deal through creative financing and obtain that property by doing it subject to the existing mortgage. And typically what you're going to do is pay the seller the difference in what their equity is. And so they may get at closing, they may get $40,000, and you take the property, and then you basically just continue the payments on the existing mortgage, and you're able to acquire the property that way. So that's kind of the differences in the three.
Mhm. Thank you. And if you like, if we maybe this is not accurate, but like if we put these different models in the category of like ways to buy real estate creatively, so to speak, like, if you were to start over your career, your real estate investing career, would auctioning tax liens be the approach you would choose? Or what did you learn after doing this 350 times, in terms of whether this is the right way to get into building a portfolio for your own?
Yeah. So, the tax lien or tax deed uh, process is a slow burn. So you need patient money, first of all. Uh, the redemption periods in most states are going to be at least a year or a little bit more than that. Excuse me. And then to obtain quiet title and to get the title clear in most states is going to be 12 to 24 months. So start to finish, from the point you buy it at the auction, it could end up being close to 3 years before you actually take that property. And so is it a good way to get properties and at a low cost basis? Yes, but it takes a lot of legal work, and you have to serve each of the lien holders, and there's a legal process you have to go through before you can actually get into that property and rehab it and sell it, or put a renter in it. So I would say it's just, you have to kind of layer in strategically, where if you go the foreclosure route or the subject to route, you're obviously able to, within 30, 60 days, you can immediately start doing what you need to do to that property, fixing it up, and then be able to sell it quickly. So, that would be the major difference. Now, I like diversification. So, you know, having done that experience, it's definitely a good investment strategy. You can actually target different asset classes within tax lien investing. So you can go after commercial properties, warehouse, office, retail space. You can go after land. Um, it's not just single family houses. So there's other things that you can strategically go after. It's just you have to accept and be okay with the fact that it's not going to happen overnight.
Okay, so it does take more time, and so what was the next stage of your career? Kind of what happened next? Of course, trying to get to when you get involved in the hospitality and vacation rental space.
Yeah, definitely. So, we're excuse me. And when I say we, it's my wife and I that are kind of in the business. So my wife today she manages all of the cleaning teams that go over our properties. She does all of the staging and setup of our properties. So I tell everybody she really does all the heavy lifting in our short-term rental business. But when we do rehab, she also works very closely with the contractors and picks out finishes and colors and things like that. And so when we started, having the tax lien properties, we also started doing, fix and flips and some rehabs. And we were probably doing about 7 to 8 rehabs a year. And like most investors, right, you want to kind of figure out, well, this is all great, but I'm working my butt off here. It's like a job. The money's great on fix and flips, but you're only good until you keep feeding the pipeline and getting your next deal done. So, like most investors, you're told, well, one option is to build a long-term rental portfolio, you know, and be able to generate that monthly passive income. So we kind of went down that road and started instead of fixing and flipping, we held on to some of those properties for the purposes of doing long-term rental. And even though we had most of those properties managed by property managers, very quickly got burnt out from evicting people right before the holidays because they're not paying, and then getting them out of the property and just banging our heads up against the wall. We got to rehab it again. It's a total mess. And then looking at the numbers, like, you're told you're doing great after your debt service to be clearing, $300 to $400 a month on each long-term rental property. So this was about 9 years ago when I looked very closely at the short-term rental model, and obviously, Airbnb was really just kind of getting geared up back then. And I recognized the benefit of that same asset, that 3 or 4 bedroom house that we have a long-term tenant in. We can invest up front, stage it, set up, put some furniture in there, develop a process to manage the hospitality aspect of it, and all of a sudden you're making 2 to 3 times the revenue that you would as a long-term rental. And so for me, that was the light bulb moment in terms of I've got assets that have the ability to generate revenue, and once I kind of did that on 1 or 2 properties and realized the operation involved with it, I kind of built it to be scalable from the beginning. And we very quickly started also doing the rental arbitrage strategy, or renting properties to do this just for the monthly net cash flow. And then also, like most short-term rental operators, starting managing properties for other investors. And so that very quickly, all through COVID, led to a portfolio of about 75 properties, mostly here in Georgia, but we also expanded down to the Tampa, Florida market. We had about 24 properties down there that were all 4 and 5 bedroom houses that were doing short-term rentals specifically. And then we decided to only do rehabs if we are keeping it as a vacation rental or as a short-term rental. We started doing some higher-end luxury lake properties up on Lake Lanier, and also looking at more kind of beachfront, coastal area type properties as well to do the short-term rental model.
So in other words, like from the short-term rental side of things, you start through acquiring, right? You buy a property, and instead of renting it as a long-term rental, you rent it as a short-term rental. Then you get exposed with arbitrage, and then the management piece of managing other people's properties came afterwards, or when did that part came in?
Yeah, it came afterwards. I think it's a natural progression, maybe for most. I don't know, but it's hard for you to want to step up and do somebody else's property if you don't already have your own properties. You're already
Yeah.
operating and comfortable with the hospitality and getting 5-star reviews and superhost status. And so, once we kind of got to that level, we started having other fix and flip investors that were having a hard time selling their great rehab, but it would make a great short term rental. So we very quickly started doing quite a few properties that way, and we still do that today, where we actually can do the short term rental operation in parallel with someone having it listed on MLS. So they're generating revenue. We kind of coordinate with the real estate agent for viewings, and we're still able to generate revenue for them. If it takes a longer time to sell.
Mm-hmm. And when it comes to your business, do you currently look at the management piece as kind of a cash flow game to try to finance more of your personal acquisitions, or are you mostly trying to grow the management side, and kind of that has taken precedence versus your own personal acquisitions? How do you look at having both the management component and the real estate investment component?
Yeah, every year I revisit strategically what the focus should be there, because honestly, you could look at a potential exit strategy. There's a lot of successful short-term rental operators that are building scalable models with great tech stacks, and you're basically able to sell that to another company at some point once you're at a certain level in certain markets. And so you could kind of build up this plan to say, okay, well, I'm at 75, I want to get to 150 or 200, and then sell the operation at that point. Or strategically, you can spend more time on your own acquisitions and your own portfolio and building up equity that way. So like I said, every year I have a different take on it, depending on where I am operationally, and so the one thing with the management, there's a lot of things that happen beyond your control, right? So owners can decide to sell the property, they can decide to convert it back to a long-term rental. Whereas if it's your owned property and you have a long-term goal strategically, you have a lot more control over it. And so, I think as we're starting to kind of venture into more of the commercial space, I think that gives us a little bit more consistency, with the ability to kind of control what the goals are with that asset going forward.
Hmm. Yeah, because again, like, I'm just painting extremes here, but I've also had people here on the show that, let's say, had a real estate investing journey prior to starting to manage other people's properties, and they've gotten so much into the business of managing and being an operator, that they've purposely, strategically decided to stop, acquiring, and have been able to scale tremendously, on the management side. Because again, the bet is, this is an asset, right? Like, this company that I'm building, these contracts here are valuable. But then I have people that are on the other extreme, which are like, oh, this property management thing is just a facade. Like, that's what I tell people at Verma that I do for a living. But like, what I actually do for a living is real estate, and I'm just looking for cash flow to buy more. Right. So you say that every year you question strategically where you are at. Like, what's this year's stake on where you want to
Yeah,
double down?
right. So I think I like the diversity of, because I also have the third strategy of I still do master leases and rental arbitrage today, right? So uh, for some investors, it's hard for them to wrap their head around investing in a process that you don't own, right? You're just controlling the property. But what I've done with it, it's a good way to increase your monthly net cash flow and have the flexibility without having all the hoops to jump through for buying a property and rehabbing it. You can very quickly get set up with a master lease, and I've found that especially with some of the multifamily building partnerships we've had, you can do it at scale, and so you can add 10, 15, 20 units, and all of a sudden you've added another 25,000 a month in net cash flow to your operation. And so, even though I've kind of shifted gears here and there in terms of what I've focused on year over year, I think I still like to have the diversity of all three strategies and have the ability to continue to manage for others, as well as doing master lease, and then also acquiring my own assets as well.
Hmm. Hmm. And I mean, yeah, from a diversity point of view, makes sense. There's people that would argue that you know it becomes challenging when you're doing, because it's essentially three different businesses, right? Three different ways of growing each of those businesses, of different metrics you got to be looking at and whatnot. So like it makes sense from a diversification point of view, but what about the potential, I don't know, distraction that might come from kind of trying to be growing three businesses at the same time? Like, what, I don't know, what's your take on, if you were recommending or giving advice to someone, would you say start here? If the end goal is to have your own properties, like don't even get distracted with the others, or the opposite, like go learn how to be a good operator through arbitrage, and then start buying your own. Like, what's your take on the orders that should be followed?
Yeah, so I kind of view it very differently from what you just described, right? So even though there's three different strategies here, they all have the same operational backbone. I still have my VA and guest communications handling all of my listings, whether they're owned, leased, or managed. I still have my channel manager connected and pushing out to all my different platforms. My price optimization and revenue management doesn't matter which of the three strategies. So because as you're growing your business, I think a lot of attention has to be on your operation and your technology that you're using in that process. And if that's the common denominator, I think it's much easier to focus on making improvements, keeping the hospitality in check, making sure you're getting those 5-star reviews, having your cleaning teams and your maintenance teams singing off the same song sheet. And so, I think that's, for me, I think that's what makes it easy to be able, or easier to be able to still have that diversification and still not kind of, have your eyes off the ball, because everything is working around that same consistent goal of getting that 5-star review. It doesn't matter where we got the property from.
Right. So you see it more as like basically you're using that infrastructure that you built, in three different ways. So it's beneficial, and I think it makes sense. Now, when it comes to the investment component, right? Going back to the original conversation we were having about the additional precision that you can have in the commercial space when it comes to determining that after repair value. What do you see on the short-term rental side, right? Like, is it a matter of time before institutions and the market starts accepting that a single family property operated as an SDR is a business and should be looked at as a business in terms of valuation? And I think a lot of people are betting on that being the case, and trying to buy a lot of single family to eventually exit as a portfolio. Or is your conclusion, I don't see that coming anytime soon? I think it's just about going on the hotel space and playing on the hotel space, if you want to truly get that commercial type valuation, because you did mention hotels as well as something you were looking into.
Yeah, I mean, I think there's the elephant in the room that we haven't really touched on, that I think is a huge hindrance to the business, and that's in the regulatory and environment in most cities and counties. That if it's not some form of restriction, it's at some point it's going to happen. And I think that's a lot of the institutional players have been kind of held back even further because of that. I think there have been some improvements or changes with a lot of financial institutions that are starting to recognize short-term rental revenue, in their underwriting process, and maybe applying a haircut. for a very long time, they only would want to hang their hat on the long-term rental. So I think some of that is starting to come around and change. And one of the advantages, frankly, of looking at the hotel opportunities is to basically avoid having that regulatory risk, and being able to still have a similar operation, um, that you would on your regular short-term rentals, but more in the boutique hotel space. Um, so I think from a business perspective, I think it makes sense to the extent that you want to have further diversification and have a little bit more control over the future, not only in regulatory, but also in valuation and future appreciation. That I think it makes logical sense to kind of look at that as an opportunity.
And what have you found out about the space of buying hotels and turning it into boutique hotels? Like, how is it different from buying commercial property or single family property as it relates to the financing that's available? Because I mean, once it relates to the operation, it's somewhat similar, right, to the short term rental side. But what about the financing and the actual acquisition process of a hotel versus commercial property?
Yeah, it's actually not too different from multifamily or office retail, because a lot of attention is being paid to what is the income that's being spun off of the property. Now, obviously, the income is very different in a hotel than it is in a multifamily building for long-term rentals, but it's a very similar underwriting process, and I think the financing options are comparable in both asset classes, in terms of the options there.
But isn't there less appetite from like financial institutions than, let's say, multifamily? I don't know if this is the case, or if this aligns with what you've seen, but I've only heard kind of loan to values being lower in terms of what's available if you're buying a hotel versus like a commercial, like multi-family building of long-term rentals, because again it goes back to like they're seeing the reliability of that long-term tenant versus the volatility of the income on the hotel side. So does it mean you kind of are left with having to go with the kind of financing options you were mentioning earlier, like hard money lenders, and then some kind of loan on top of that as well for your carrying costs, if you want to have better loan to values, or you have seen kind of reasonable loan to values too on the hotel side?
Yeah, I have seen more reasonable loan to value on the hotel side. I think it's not too dissimilar, frankly, from a distressed single family house, as it is for a distressed hotel, right? So you can still pick it up at a discount, make those improvements to it, and but in the case of the hotel, you're increasing revenue, and so your revenue potential per door compared to a multifamily is definitely higher with hotels, and so I think some of the lending institutions recognize that, even though it's not a consistent, steady income flow like multifamily, they recognize that the revenue is going to be more than what it would be as a multifamily. And there's a lot of multifamily investors that are getting hit hard with a lot of the issues that are happening with the higher rents and people not being able to afford it, and problems with evictions, and there's been a little bit of a disruption in that space. Not to mention the inability with the higher interest rates to really get into that same place you were 5-10 years ago with multifamily. So I think there's a lot of lenders that are or institutions that are looking at the hospitality space as an alternative to multifamily as well.
Hmm. Hmm. And where are you at in that process of getting into the hotel asset class?
We've got about three properties we're currently evaluating. One of them we're about to go into a letter of intent with, and hope to get it closed here, by January, February of next year.
Nice, nice. And has it been more challenging to find deals, as far as hotels goes, or are they, also on Zillow? Like, how have you gone about, finding those opportunities to then evaluate?
Right. So it's very similar to the residential space, right? So you've got uh, you know properties that are going to be listed for sale, on LoopNet or other channels, and then you've got properties that aren't necessarily thinking about listing, but they are in a distressed situation. They want to retire. Their properties are in disrepair, so they can't really list it as is. So it's a very similar marketing strategy as it is in the residential space, that you're going to get your better deals from pursuing, kind of an off-market pipeline and looking at those opportunities. We still look at the ones that are listed, but a lot of the better deals are going to come from the off-market situations.
So is tax lien auctioning something that you're also gonna look into for buying hotels? Like, is that also a thing?
It's because of the slow burn on it, not necessarily because your holding costs for that. If you've got a $600,000 delinquent tax bill on a hotel, and it takes you 2 years to get the hotel, then you've got to pay interest on that 600,000. So
Mm.
didn't necessarily fit with the patient money
Hmm. Hmm.
opportunity.
Hmm. Okay, got it. When it comes to this hotel projects, what's your take on kind of like branding when it comes to your hotel? Like, you think of this as it's going to be a boutique hotel, your own branding, your own everything, or would you consider putting in a franchise of some sort, or like what's your view on that?
Yeah, I mean, I'm not dead against franchises. There's a reason why those are successful. And I think every opportunity, every property is going to be a little different in terms of what the exit is with it. And in some cases, we may end up doing kind of a new brand and do some creative things with amenities to make it unique. But in other cases, there's a project we're looking at now that it's a family-owned resort with cabins that's been around for 50 years. They have a lot of repeat business, and so in that example, we definitely would come in and do some value add and improvements, but we may not necessarily want to change the brand. So I think it just depends on the project, essentially.
Mm-hmm, mm-hmm. Yeah, makes sense. Tell me a little bit about BNB Investing Podcast. How does that project come about? And I'm also curious to know what have been some of the main learnings, the main insights, lessons that you've gotten from interviewing so many people.
Yeah, absolutely. So, a few years ago, I started BNB Investing Group. It's a Facebook group that I formed that I also do a weekly podcast in, and so the kind of the main focus is talking to experienced, successful short-term rental investors that have different niches. So some only do arbitrage, for example. Some only do management. Some have lakefront properties that they focus on, or high-end beach properties. Others do accessory dwelling units, container homes. So there's a lot of different niches that we've kind of explored. And so the intent with it really is to talk about each of their stories, how they got started, what they've learned along the way. And it's a good kind of overview for folks that are thinking about getting into short-term rentals or thinking about growing their business to the next level, and looking at different niches and different options, and how other folks have been successful in getting there.
And is there something that like I've learned a ton from this one conversation with you alone? Like, is there anything you look back at, in terms of like lessons from having run this podcast project of yours, that you would like to perhaps share here as well with the audience?
Yeah, I think it's definitely interesting the different ways that we can apply short-term rentals. It doesn't necessarily have to be an apartment or a single-family house. There's a lot of different niches. There's a lot of successful investors that maximize their property, and so There's a lot of different cities that are now allowing accessory dwelling units. And in some cases, you can put one or two tiny houses on your property. So there's been a lot of investors I've talked to that have been successful with doing that. Your cost basis to put to do new construction for that compared to your potential revenue, even if you were to do long-term rental revenue on a tiny house, is compelling. Even though it's a 600 square foot structure, you can command a premium of 1,800 to 2,000 a month just as a regular long-term rental. And obviously with short terms, you can do 250 as a nightly rate as well. So there's some interesting things that you can look at and apply. If you have a clean slate, you've got money to invest. What are the options economically, and where do you get your biggest bang for your buck? There's also some creative things with cabins that are kind of prefab that can be put on different land lots and start generating revenue as well. That we've had a few of our students in our program that have done that as well. And so it's interesting to see and learn about, what does it cost to do that? How long does it take? What's involved with zoning and permitting and things like that. And just to know that those options exist, I think is good as an investor to have in your toolbox, because any property that you invest in, you just never know what the best use might be for generating revenue.
Mm-hmm. That's interesting. Now, let's say you have a crystal ball, right? We all wish we had that. Let's say you have one. What do you see in 2025 as far as the number one opportunity for operators or investors in the short-term rental space?
Well, I think we've all experienced over the last 18 to 24 months the slowdown in occupancy and nightly rates. And so, in addition to my podcast, I do go to different markets and talk to different real estate investing groups about what's happening in their market. And there's a consistent theme that's happened. And I know a lot of us that are operating in this short-term rental space in most cities already kind of experience this and acknowledge there's been a slight increase in supply that's outpaced demand. And it's created a lot of kind of fly-by-night hosts that aren't treating the guests the way that they should be treated, and basically creating bad experiences and kind of additional bad press, pushing people back to hotels. Which has really kind of caused not only the increase in supply, but it's also kind of given us a little bit of a delay in all the other great things that we do as short-term rental professional operators. And so, as I go to each market and look at the last 3 years historical data on ADRs and occupancies, there's a consistent theme that seems to lend itself to recovery from what we've all experienced over the last couple of years, in that year over year, consistently, there's a slight increase in ADRs and occupancies from the prior year. And so I think what we're experiencing and going forward is this natural kind of flush of the system of, ultimately, if you're just kind of throwing up a listing and adding to the increase, something like 1.8 million listings now, which has been the highest ever for Airbnb. We're starting to see a decrease in new listings coming out, and we're also starting to see a degradation, and a lot of those additional supply bad hosts are kind of weeding themselves out of the system. And I think that does nothing but create opportunity for those of us that are doing it the right way and focused on hospitality, understand where the priorities need to be in our business. And I think it's going to create more opportunities going forward, considering kind of where we've been the last couple of years.
Yeah, no, absolutely. I think you break that down pretty clearly, because we have been hearing a lot about that increase of supply outpacing demand. And I think what you say is interesting in terms of the bad players that have come into the market are weeding themselves out. Airbnb is helping with their more strict policies around quality, and not having the ability to relaunch listings if there were issues related to reviews and whatnot. it's also putting pressure on those that are trying to do things well, I believe, because by the nature of the way that averages are calculated, when you have a larger portfolio, it's tough to maintain those standards, because one bad review from one bad guess at one of your 70 or 50 properties can kill your overall ratings too. So it presents opportunities, but I think it's also becoming more challenging to excel, from a hospitality perspective. How are you trying to navigate that and maintain those quality standards despite the gravity or inertia of scale and the pressure from the OTAs to maintain that quality?
Yeah, and that's a constant battle, because it's almost like you don't want to grow too quickly, because you always have to make sure you have that in check. I think there's a lot of things you can include in your operation from an asset management standpoint that allows you to be proactive. And so, simply not waiting for something to go wrong at properties for a guest to complain about it, but already have as a part of your maintenance program to make sure that you're going in at least once a month or every 2 months and spot checking. The cleaners aren't always going to report back to you that, oh, they banged the luggage across the wall and there's this 3-inch black streak. And so if you don't proactively attack a lot of those small things, very quickly you can blink your eyes and that property is going to be in bad shape and cause problems. And so in addition to the standard things you should be doing anyway, like changing the filters, changing all the batteries on the remotes, I think you want to try to be more forward looking and don't wait for something to have your pest control maintained correctly. So there's a lot of different levers that we have that we can kind of get ahead of stuff, so that when you do it at scale, if you don't do that, you're gonna very quickly get into trouble. And so, I think that's one way that you can kind of keep that balancing act to make sure that you're keeping your finger on the pulse. And then, obviously, those of us that have been doing this successfully, I actually like it when things go wrong, because your guest is going to be, responding to how quickly you respond, how do you resolve a certain situation. So it goes back to some of those hosts that don't really, when they have a problem, they kind of run away from it. They try to ignore it, or they don't handle it in the correct manner. And it just kind of gets things to be a lot worse. And so, as long as you have your team and everybody, in along those same lines and understand what those priorities are, and you just have to kind of keep your finger on the pulse and make sure you maintain it, because
Mm-hmm.
as you scale, and like you mentioned, it only takes one or two bad reviews to start moving you sideways. And so
Mm-hmm.
you constantly have to be on top of that.
And you mentioned a very good point, which is on being careful not to grow too fast. Um, I usually don't promote things within the podcast, but just happens to be fresh top of mind that with Angel Hose we were uh, basically making a proposal to make a presentation at one of the upcoming conferences. I believe it was for STR Nation, and it was the subject of the presentation was something along the lines of how downsizing can sometimes be beneficial for operators and property managers, and how we think more and more and more. Well, sometimes taking a step back and letting go of certain owners and structuring things differently to make sure you're more profitable, you can end up with less properties and more profit. So you because you went through a somewhat of a downsizing process, I'm curious to know your thoughts on precisely that, downsizing as a strategy. What why did you go through that, and what did you learn in that process?
Yeah, I mean, I think when you're starting out and you're growing a business, especially on the management side, you are basically taking on clients that have a pulse and have a property that needs staging, right? So, and that's kind of the nature of the beast. You want to grow your business. You want to get to so many units quickly. However, you're going to very quickly acknowledge that not every client is going to be a good profitable client for you, and so once it takes a little bit of time, but once you get to that place, you can strategically, we've fired clients, and kind of, if you're spending 90% of your time with 10% of your clients, that becomes very counterproductive. And if you get rid of those 10% of the portfolio, it's going to make you a lot more productive. And it's the same thing with rental arbitrage. If you have properties that are problem properties, or the monthly numbers become to be too tight, there's been cases where we've had like a building with 20 units in it that we decided to not renew the leases because the profit margins were getting too tight. And so you have to, sooner than later, be disciplined to make those decisions. It's not a bad thing to, decrease the portfolio if you're making major improvements, leaps and bounds that way, because then it allows you to be a little bit more forward looking as you start to take on new clients, and be a lot more selective that way too, instead of just onboarding them and kind of dealing with whatever the situations are. And so we're very selective now too with any new management clients as a result of that, because you can very quickly get into trouble if you have a handful of clients that are either micromanaging, or they don't trust your ability, and they want to get involved, too much involved with the process.
Mm-hmm. Yeah, no, and again, we talk about this a lot here, but we always say that because of the nature of property management business model, like you're taking a commission on revenue generated by a certain property. You can have the property that has the most potential in the world of generating revenue, but like if the owner is not giving you the flexibility to set your pricing in a way that's competitive, and or not giving you the availability in the calendar that's needed to get it rented, then you're going to be losing money, right? Because you're going to be having to pay for all of your fixed costs out of pocket, and you're going to have no revenue coming in, or very little revenue. So I think that's the mistake, right? That sometimes operators think, oh, this property has such an amazing potential. Well, yes, but is the owner going to allow you to fulfill that potential, right? And that opens a discussion on homeowner education and all sorts of other things, but I think it paints a picture. Reach, any final thoughts, any final words of wisdom or advice? If not, just kind of where can people get in touch and stay tuned with your podcast and everything you have going on?
Yeah, so Sebastian, we didn't spend that much time, although we started in the beginning talking about what happened in the city of Atlanta with the regulatory environment and the nonprofit that I started. So just to share with everybody, I formed that association when the ordinance had already been voted in, and we were still successful to be able to put that nonprofit together, raise a legal fund, and basically fight it. And they've been delaying enforcement. And so if you have an aggressive regulatory environment and you need help with it, there's a lot of resources out there available to you. There's an organization that was very helpful in getting us started, called Rent Responsibly. They attend a lot of the short-term rental conferences as well. We also had some help from Verma and their advocacy group. They contributed to doing a feasibility study, and also contributed directly to some of the lobbying efforts that we had here locally in Atlanta. And so reach out to those two different organizations if you have something that's coming up in your environment that's causing havoc with the short-term rental rules. And these folks are experienced in a lot of different markets, and they can definitely help out, with rather than you starting from square one. It's all about a grassroots effort, but you've got resources that are available there to help you with that process.
Right. So in your case, you've managed to delay the enforcing of those harsh regulations. Any clarity on what's missing for them to not just be delayed but be kind of canceled or postponed?
Yeah, so we've had in the last, actually in the last week and last month, we've had some of the council members in Atlanta that have made some proposals for changing the ordinance and getting it, redone. And so we're currently working with them on some of those changes to hopefully get it across the goal line. I think a lot of the local jurisdictions are recognizing the World Cup that's coming to Atlanta and some of the other large events that they want to make sure that they kind of get this defined and in place before then. And so I think it's been a couple of years now, but I think we're getting close to getting something that'll be updated.
I mean, I think it's a good example that we can decide to take one of two approaches in life to anything, right? We can take the victim side of things and be like, oh, this is happening to me in my market, like, what, poor me type of thing. And then you can be proactive, like you're doing, and try to fight back, form an association, whatever. And sometimes it's going to be successful. We all hope that would always be the case. But even, whatever the outcome is, the fact that you tried to fight back and not just take whatever was enforced, because sometimes that's not well thought of, or it doesn't have all the context or the perspective of an SDR operator. So I think it's a great example of how we should take that kind of a leadership role, and because if not, then the industry is at risk. And thanks to people like you that don't just accept what's out there, we continue to thrive as an industry. So thank you for your advocacy efforts as well, Rich, and for your time here today. It's been great. i
Yeah.
could i could keep you here for 2 more hours nonstop, believe me. But I'll let you go. I'll give you a break. And it's been fun. Thanks so much for taking the time. And yeah, it's been a lot of fun. Thanks for being here.
Yeah, Sebastian, thanks so much for having me. And folks that want to stay in touch, you can join my Facebook group at BNB Investing Group, or you can also search on Apple Podcast or on YouTube for BNB Investing Group to check out my podcast as well.
Awesome.
Thanks for
Thank you
having me,
so
Sebastian.
much.
Appreciate it.
All right. Thank you. Bye-bye.